Hello, good afternoon. Thank you everyone for joining our live webinar today. The webinar for today is titled China Reopen. Yes, it's hosted by PropertyGuru Asia, PropertyGuru Asia Real Estate Summit, the tech and thought leadership platform of PropertyGuru, Southeast Asia leading property technology company, which also organized the industry-leading Asia Property Award Series. We would like to thank our partner for this webinar, PropertyGuru Age Property Report Magazine, Artemis Associates, and TechNode Global. Today, we will be discussing the reopening of China's real estate market, which has slowed down in the first quarter of this year. We will be examining post-pandemic investment options and delving into changing consumer behavior and other trends taking root in the Chinese real estate market. Just a little housekeeping before we get started. If you have any questions during the presentation, which is the first half of this 1 hour webinar, feel free to type in the questions into the Q&A box in your chat. Towards the end of the webinar, there will be a question and answer session once all speakers have finished their presentation. Without much further ado, let me introduce the speakers for today. First of all, we have Mr. James Macdonald. He's the Head of Research at Savills China, who will be discussing property prices and new construction projects in mainland China, focusing on both residential and commercial properties. Dr. Gan Lu, our second speaker, is founder and CEO of TechNode, who will speak about digital trends and consumer behavior in China. Our third speaker, Mr. Vincent Cheong, is the founder and managing director of Vincom Consulting and Appraisal and PropertyGuru Asia Property Awards judge, who will share insight into Hong Kong property market in its current social political situation. Our fourth speaker, Mr. Ivan Lam, is the Head of International Business at Charter Kramer, who will be examining the recovery of property markets post-pandemic and cross-border demand, with a special focus on cross-border demand between Chinese investor and Australia. And the fifth speaker is myself, Winston Lee, the Director of Special Projects for PropertyGuru. Today, I'm doubling up as both the moderator and also the speaker, as our colleague Juice has something important and urgent to attend to. So I will focus on talking about the COVID-19 impact on the Chinese real estate market, as well as its implications for overseas real estate market, especially focusing on Southeast Asia. Without much further ado, let us hear from our first speaker, James. Over to you, James.
Great, thank you very much, Winston. So as Winston said, I plan to try and cover within 5 minutes, hopefully, the commercial and residential property markets in China. Next slide, please. Next slide, please. So obviously the first thing you have to know about China is it's an incredibly large market, and not only do we have diverse peoples and diverse geographies, we also have quite diverse property markets. And also the impact that COVID-19 has had on different regions has been markedly different. Obviously, the first detected known case of COVID-19 was in Wuhan and Hubei, but it spread to many other markets. We had certain cities, certain provinces which were under lockdown for longer periods of time, and certain cities which are still under some form of restrictions in terms of movement or in terms of sort of office capacity. Next slide, please. The impact that the COVID-19 has had on terms of the business community has also been different for different industries. Obviously, certain sectors of the economy have been more affected than others, and also different parts of the country have been affected more than others. But generally speaking, for the first quarter, we didn't see too much of a change in terms of either the occupancy rates or rents. We did see some increase in occupancy rates in markets where we saw new supply coming on in January before COVID-19. But in other markets, we actually saw a slight decrease in vacancy rates, given the fact that there was no new supply in January, and we did actually see some take up. Generally speaking, we saw that rents in most markets fell, but that was part of a longer term trend that we've seen over the last year or so, given a slowing of the economy due to financial de-risking that's taken place. Next slide, please. I think in the first quarter, we were sort of relatively concerned about the state of the economy. We weren't seeing too much support from the government. It was more about business resumption and getting the economy back on its feet. But I think at the moment, given sort of the international situation and given sort of the inability for the economy to get back up to 100%, that the government stepped in, and we've seen more positive rhetoric in terms of both monetary and fiscal support. And we believe that certain sectors of the economy could actually see a pickup in terms of demand and pick up in terms of activity. Those ones sort of being the financial, the healthcare, IT and tech sectors, e-commerce, FMCG, and the online services and entertainment sectors. Some of those have been positively impacted by sort of the lockdown. Others have had more sort of structural support over the last year or two. Next slide, please. On the retail market, we saw retail sales growth rates towards the end of last year around about 7 to 8% year-on-year growth. That obviously, during the first couple of months of this year, we saw a significant contraction with retail sales dropping by about 20% or so. We started to see that recover. Likewise, if you look at consumer confidence, we're close to all-time highs in terms of consumer confidence. That's had the COVID-19 outbreak has had an impact in that. We are still at relatively high levels at the moment. The slide on the right-hand side, so the chart on the right-hand side, also looks at the proportion of online retail sales as a percentage of total retail sales. We see that it's been steadily increasing since, well, prior to 2014, but the chart only shows 2014. So it's gone from around about sort of in the low single digits all the way up to around about 20% by the end of 2019. And in the first quarter, we saw that increase further still, obviously as the physical retail market got heavily impacted by sort of lockdowns and restrictions in terms of travel. Next slide, please. Likewise, like I said, we saw a 20% drop in terms of retail sales in the first couple of months. That was didn't affect all consumer categories the same. We saw obviously food being less impacted than others, and communications, medicine, daily goods, and cosmetics were impacted by only sort of 10% or so. But other sort of more discretionary expenditures such as automobiles, furniture, and jewelry were much more heavily impacted. Some of those did see a rebound, as you saw deferred purchases versus just more destructive purchases. And so we did see some people coming back out of lockdown and deciding to buy that car that they've postponed purchasing from sort of February. So we have seen a recovery in terms of certain markets. Next slide, please. Some of the more interesting things that we've sort of seen in the last couple of months have been maybe something that you would not be expecting. One thing we've seen a pickup in terms of tourism quite rapidly, and also the nature of the tourism is quite different because obviously, in addition to domestic tourism, there's been a significant wave in terms of outbound tourism over the last 5 to 10 years, and that's obviously benefited a lot of overseas destination markets. Obviously, with limitation in terms of overseas travel, a lot of that travel is now sort of coming back to China. A lot of that is the relatively high net worth individuals who are willing to spend a significant amount of money in terms of luxury products. And again, so that's sort of benefiting the Chinese domestic market in terms of luxury product segment. Technology, obviously, there's been significant application in terms of technology over the last few years, but obviously that's been sort of stepped up in the last sort of 6 months or so. And that's also giving the analytics behind both the online and the offline markets. And also now what we're seeing is sort of a real merge between sort of not just having a online sales channel for offline products, but a real sort of merging in terms of the two platforms, both sort of digital penetrating into the offline universe, but also the physical actually being transferred into the online market. So one of the pictures there is an online fitness course. So a lot of the gyms obviously shut down during COVID-19. A lot of that has been replaced by Zoom calls with your fitness trainer. So it's really seeing not just the sales channels being pushed online, but also the services being provided online as well. And also the last one there is really policy support. So the government's been very much about supporting domestic consumption, really because the overseas markets are seeing a shortfall in terms of demand. So you're looking at replacing that with sort of domestic consumption. So we've seen an increase in terms of coupons which have been issued, an extension of weekends or advice from local governments for businesses to extend weekends. We've also seen sort of shopping festivals which have been initiated in places like Shanghai and Beijing to increase consumption. We've also actually seen a rollback in terms of policies about street stores, so the street markets as well. So we're actually looking forward to that. Next slide, please. So touch on the residential market. We have obviously seen a reduction in terms of the loan prime rate, which is our equivalent of the sort of benchmark lending rate at the moment. So the 5-year loan prime rate is down by 30 basis points to 4.65. And that has started to have an impact in terms of mortgage rates being issued by commercial banks to home purchasers. So they've started to trend down over the last few months. At the moment, first tier cities, if you're buying your first property, you should be able to get an average of about 4.69% on your mortgage policy. So that's coming down, and that's what we're trying to support the residential market to a certain extent. Next slide, please. This then looks at weekly transaction volumes. So this is information provided by CEIC through the offices. Resulted in minimal purchases in February, but we saw a gradual rebound in terms of those volumes. However, the first quarter of the year, we did see first tier cities seeing a year-on-year reduction in terms of transaction volumes by 41% and second tier by 35%. Transaction volumes have recovered to previous norms by mid-May, and they've actually exceeded previous norms by the early part of June. Next slide, please. And likewise, we've seen sort of something similar happening with in terms of residential prices. So we saw the first couple of months of this year, the pricing was relatively flat. Again, developers weren't willing to change pricing at all because they didn't know what once we came out of lockdown, what the market situation would be like. But obviously, as we've seen an improvement in terms of market sentiment, we've seen a reduction in terms of interest rates, transaction volumes starting to recover, that the actual pricing has also recovered as well. So we're actually looking at growth rates for a basket of 70 different cities, coming back up on a month-by-month basis by about 0.4%. So we're starting to see that recovery in terms of the residential market going forwards. And with that, that's my whirlwind tour of the commercial and the residential markets of China. Thank you very much.
Thank you, James. Next up, we have Dr. Gan Lu. Dr. Gan Lu, over to you. Thank you.
Hi guys. Yeah, thanks to have me here. I'm sorry. So since we only have like 5 minutes, so maybe I can just quickly go through basically how we see, and from the startup point of view, and how we see how China recover from the pandemic. I think in general it's always challenging versus opportunities. But even we have to see some, from positive angle, and we are keep telling the startups how we're going to recover from pandemic. But we have to admit that 2020 will be a very challenging and tough year for many startups, and especially for those who heavily relies on offline activities, and for example like travel and logistics, and of course even like retails. So pandemic will change everything. I think the second point I want to kind of emphasize here is, if you ask me why kind of China can recover from pandemic quickly than some other country, at least from me and from technical and from tech point of view, I think all these examples we see in the tech space actually is not really invented, like suddenly during the pandemic. Actually, all the technology, all the service, it has been in China for 1 year and probably over 2 years. So pandemic is not create something new in the tech space, but basically just push everything move much faster than before. Okay, next slide, please. Yeah, so first thing is we want to focus a little bit more on the retail and also on automation and robot part, and because is everything is to do with probably the real property business. So if we talk about retail, this just happened in past 2 weeks. And JD is number 2 or number 3, probably the e-commerce platform in China. It buys 100 million convertible bonds in gourmet retails. And also on the other hand, Pinduoduo is like a really head-to-head competitor with Alibaba or Taobao. also invested another 200 million in the same company. So you can see how actually the pandemic probably the speed up the kind of collaboration between the online business with the online retail with the offline retail business. Next slide, please. And this one is huge right now in China. And so basically, we talk about live streaming. Everybody probably know, TikTok or live streaming service in China. But in past like 2 months, especially when pandemic happens, we see live streaming plus e-commerce. So basically, you see all these like internet celebrities, start selling stuff, and when they are doing live streaming, and some of them actually they are they're selling billions of RMBs per day and per month. So there are some superstar there. And also what happened last month is not just like all these internet celebrities. And you can see some big figures, like Robin Li, the founder of Baidu, and the founder or the CEO of Agree, and many others. They are like very, very popular and high profile, like tech company leaders. They are sitting before the camera and try to sell their own service. For example, I just mentioned the travel business is really suffering from pandemic, and especially the outbound, the cross-border travel. And you see like the CEO of C-Trip, and they do the same thing. They're sitting, they try to kind of promoting their travel, travel service, and using live streaming. So I think it become I think we see this is it happened during the pandemic, but it's going to be what we call new normal. It wasn't normal because we didn't see that before, but I think even after pandemic, we can see this type of e-commerce plus live streaming. I think it's going to be last very long. Okay, next, please. Okay, so I think if we talk about the offline, it's quite interesting. We see probably we get more and more attention. We talk about robot or AI or automation. And I think the robot are kind of speeding up to be part of our life. Let's give you a few examples. And next, please. So we see robot almost everywhere now in China. And so here's you see it's a Hopper restaurant. So you see the robots is doing the deliveries, food deliveries inside the restaurant. And next one. And this one is the hotel. So basically, because we saw, and I think this type of a robot, they can deliver the bottle orders or some other goods. So basically is come with the containers, and you call the number, then 5 minutes, this guy will deliver the order to your room. And next one. And this one is, we saw that in many and more shopping malls, and for promoting or marketing purpose, and sometimes it has screen as well. So basically can guide you to the to the specific shops, and also basically like shopping guide. And next one. And this one is, I think you see more during the pandemic is, when you enter the building, the working space, you always see like a kind of screen like this. Basically, you have the camera there, and with the kind of AI technology and also some other technology, and automatically to monitor the temperature of each one, or each person who walking in the building. And next one. And in some public place like airport, and you see some type of this robot, from the police station. So basically, you can walk around, and they can also monitor your temperature, and of course, because it can also monitor your behavior in the airport as well. And next. So just a really quick summary, is I think for startups, because when we talk about the recovery, I think for startups always opportunities, but I think considering the pandemic, the damage brought by pandemic, I think for all startups we have to realize, for startups always cash flow is really important, and the key is always to survive first. I think seeking for new opportunity and stay strong until everything come back to the normal or new normal. And also, because I think we spend lots of, we talk about online and service, so we talk about, okay, we should move everything online, but I have to keep in mind, I think also pandemic also told us there's something, some service, I think online cannot really satisfy everybody. Online cannot really replace 100% offline business. So I think, for example, like even online education, even the retail, I think is within after the pandemic, I think there are something we will come back to our kind of offline life, because we see for them online education, we want to be more interactivity between the student and the teacher, but with the current technology, we can do that much. Maybe in 5G, we can do more. And for the retail and business, it's the same, because we really want to try to go to restaurant and enjoy the environment. And so, but this is not something online can give us. So do keep in mind, we just need, the offline business have to adopt more digital solution, but don't give up on offline. I think always opportunity there. Okay, that's all I have today, and thank you.
Thank you, Dr. Gan, for a very insightful session about online and offline. We can have further discussion later in the panel discussion. And next, let's have Vincent to share with us. Vincent, over to you.
Hi, thank you, Winston. Recently, I heard quite a lot of the rumors and also the concerns about the Hong Kong property market due to the tension between US and China and also the pandemic situations. The people's concerns are around like the interest rate, the capital outflow, currency stability, and also the money supply. And I try to use some graphs and statistics to explain, say, how's the current situations in Hong Kong. Actually, China was the first country to confront the coronavirus, and China has more than 83,000 confirmed cases and more than 4,600 reported deaths from the disease. Even though China cities implement restriction at different times and by different measures during the period, such as the invention of the digital color codings for the citizens to check and recognize the health conditions of them in the country. But comparatively, Hong Kong has far less confirmed cases. The first time, say, we found the confirmed cases was on 23rd January 2020. But up to now, there are about, say, 1,108 confirmed cases. And fortunately, only 4 people who have died from the COVID-19. When we look back to 2003, there are about 1,700 cases, confirmed cases during the SARS period, and more than 299 people deceased due to the SARS. So compared to 2003, the current situation in Hong Kong is not that bad, but the impact of the COVID-19 to Hong Kong is also significant, because we note that we see that there are quite a lot of confirmed cases outside of Hong Kong, and it triggered a lot of the, say, financial and economic impact to Hong Kong. We look back to the property markets. Since Hong Kong's handover to the motherland in 1997, actually Hong Kong property market experienced both ups and downs. But in general, the price of all property sectors are on uprising trend. Compare the property price between 2020 and 1997, you can see that the residential home price increased by 121.8%, which is quite amazing. However, it is not the most robust market. You can see that the office price also increased by 122.3%, and the retail property market increased by 161.4%. So you can see that overall, the retail property market outperformed the home market and the office market in the past 23 years. However, if we just compare between 2020 and 2008, especially after the global financial crisis, the GFC, and the quantitative easing, you can see that the home price increased by almost 3-fold, and the office price increased by 2.2 times, and also the retail market increased by 2.5 times. And since the start of COVID-19, the home price has dropped less than 1%, but the office price and the retail property price have dropped to more than, say, 10.7% and 2.4% respectively, from January to April 2020. In addition, the home price also dropped less than the other sectors from the time of the anti-extradition bill movement in Hong Kong last year to now. The home price dropped by 3% from the last quarters in 2019 to 2020. But the office and retail property price dropped by 23.1% and 7.1% respectively. So based on this data, obviously the home price rose faster than the other property sectors, and the home price is also more resilient after the unexpected incidents, such as the anti-extradition bill movement and the COVID-19. Next slide, please. Another concern is about the money supply. The property price in Hong Kong, especially home price, has a strong relationship with the Hong Kong dollars money supply, especially since after the 2008. The money supply in Hong Kong increased by 4.3 times from 1997 to now, and the MV has increased also by 2.4 times just since after the 2008. The increase in money supply caused the depreciation of the money purchasing power, and it also explains why the home price is more, say, resilient to the harsh market conditions, especially the undersupply of the housing in Hong Kong. And next slide, please. And another rumor is about the stability of the Hong Kong currency. Actually, the market rumor that Hong Kong is experiencing or will experience a significant capital outflow since the mainland China government's proposal of the Hong Kong National Security Law on 22nd of May 2020. However, the strong money supply and monetary-based data explain that it's not the truth. Hong Kong dollar is stronger than ever, as our current interest spread between the LIBOR and HIBOR is around 50 basis points, which attracted people to do the carry trade in Hong Kong. That means they sell the US dollars to buy the Hong Kong dollars to gain the interest spread. So another thing is that Hong Kong dollars has packed with the US dollars and has both strong side and the weak side convertibility undertakings. So that's why the Hong Kong dollars fluctuation is just between $1 to 7.75 to $1 to 7.78. So the volatility is very mild. That's why Hong Kong dollar is comparatively safer than the other currencies against the US dollars. And that's why it gives the comfort for the people to invest in the assets in Hong Kong. Next slide, please. In the past, the investors would monitor the change of the US dollars, the DXY index, and its impact on the property price, as the market believes that the increase in the DXY will cause a fall in Hong Kong property price. And such correlation has been proved since 1997, but just up to 2008. Since after the QE in 2008, you can see the Hong Kong property price is less sensitive to the interest rate changes, as the interest rate has been dropped to the all-time low. In addition, the strong US dollars in recent years was not owing to the expectation from the interest rate high. It's just because of the weak euro and GBP, as both currencies comprise almost 70% of the DXY index. So the weaker the euro and GBP, the stronger the USD and the DXY. And it also explains why the property price, especially the home price, keeps falling even though the US dollars remain strong. So in the short run, there may be some hiccups on the Hong Kong property market, but to me, I'm still quite positive and pessimistic about the future and the price of the Hong Kong properties in the upcoming 3 to 5 years. Okay, that's all for me right now. Thank you.
Okay, thank you, Vincent. Next up, we have Ivan, who will share with us about his insights on the Chinese-Australian interface. Over to you, Ivan.
Yep. Thanks for having me. Yeah, we can go next slide. Good. Disclaimer and next slide. Okay, well, let's start with something quite interesting. This is from our Prime Minister, Mr. Scott Morrison, recently. The March quarter GDP comparison with the other developed countries. So although we are not immune by the pandemic, but it shows our resilience in Australia, where the economy shows we're comparing to the others, we are doing pretty well. So there's a lot of efforts put in, but we also want to look at what China is doing right now with the GDP. The GDP dropped by to almost 9%. So let's go to the next slide. If China reopens, I saw the other presenter, I think Mr. Dr. Liu, with what happened in 2003 during SARS and during GFC in 2009. China will stimulate its internal domestic economy by pumping a lot of money into its economy. So trillions of dollars is going to put into the infrastructures to invest into fixed asset investments, greenfield projects, and in the race to the recovery. So China actually has the upper hand because, well, China can actually manufacture and go on to do all these infrastructure projects in preparation for the future. So we saw what happens in the past where there are empty spaces that has been created. There are highways that not many people are using it. Even the Hong Kong, Zhuhai, Macau bridge, I think is a mega structure that not many people are utilizing at the moment. But eventually, it will get absorbed and the utilization will go up. So the central government has the control, and the people are actually backing them in general. So which is a very powerful impact to the recovery. So the Chinese government also trying to actually strike a balance between boosting the consumptions and to contain the outbreak from increasing public gatherings, allowing outdoor activities because summer is coming, so people wants to go out and about, to hopefully boost local spending. So I know that China domestic traveling is allowed to a certain extent, and people are trying to actually go to somewhere like a Macau or a weekend getaway. So let's go to next page. So I want to touch base on Hong Kong. This is something that is quite interesting. I think, as Vincent says, Hong Kong remains very resilient, and Hong Kong remains a good destination for people to invest in. So we always says Hong Kong is a gateway to China. A lot of the transaction is completed in the special administrative region due to its legal system advantage using common law. Setting up company is very fast and transparent. The tax rate is very low. And the IPO, as the global IPO hub, you can see the previous presentation from Vincent. Raising capital is very easy. Hong Kong has got a lot of capital there. So let's move on to the next one. So let's have a look at what's happening between Australia and China. There's definitely a lot of conflicts between the two countries at the moment, and it has elevated to a new level. It originated by what happened with Australia, which led an independent inquiry into the origins of the coronavirus. And China accused Australia it is a politically motivated campaign. So China fought back, increased tariff on our barley by 80% initially, and now they are actually putting up travel warnings to the people as the relationship goes south, and they're advising students not to come to Australia to study and they're looking at asking the Chinese not to go to Australia to visit. So which will actually definitely hurt the Australian economy. So it is Australia's largest trading partners, but the tension between the two countries is going to make things a lot difficult. There's no foreseeable future between a travel bubble between Australia and China, not within the next 12 months. The Australian government also encourages Aussies to stay within the country to stimulate domestic economy. And so which from a real estate point of view is very difficult for anyone to invest into another country. So it will be very unlikely for Australia to put in a lot of money into invest into China and vice versa. Now, the Victoria is maybe have a better position. Interestingly enough, within the whole of Australia, Victoria is the only state that has signed the Belt and Road Initiative, despite the federal government objection. Let's go to the next page. So it is very important. Property is Australia's #1 industry, and the industry didn't stop during the pandemic. You know, the construction's property industry is deemed to be an essential industry. So everything was going on as much as we can with a lot of protective measures, social distancing, and regulations in place. Now, well, 2 days ago, we have topped up a building which is the tallest building in the Southern Hemisphere, 319 meters. We can see that the one in the cloud. So there is a task force committee which has set up to fast track a lot of reshuffle-ready development to continue stimulate the property industry with about more than $1.2 billion of building and development has been approved. So including there's another very big development which is going to be replacing this tallest building to become the #1 building in the Southern Hemisphere. Is going to be a mixed-use development over 100 floors, 352 meters has been approved amongst those projects. So there's a lot of things that there's a lot of opportunities in Australia, and in particular the property sector. So I will stop here, and we can actually discuss more after the presentations. Thank you.
Ivan. Next up, the speaker is myself. I will start sharing my screen. Yes. The topic of my discussion is, can you go back one screen? The topic of my discussion is China reopening, implication and opportunities for real estate developers. We all know that China is now the biggest market as far as outbound real estate investment is concerned, with 1.4 billion people and a huge middle class that is even bigger than many countries around the world. So therefore, many developers, overseas developers, see China as a very attractive market and also too big a market to ignore. As a result, PropertyGuru, we have formed a China business, and myself, I'm spearheading the China business. So far, we have assisted more than 60 developers to penetrate the China market with our program. Next. So a little bit about COVID-19. What COVID-19 has done is it has basically plunged the residential real estate sales in China in the first 2 months of this year. So in February, the China home sales dropped by 90%, which is not surprising because everywhere is locked down and show flat is not allowed to open. Next. However, that said, there are some very creative Chinese developers who still manage to sell properties even during the COVID-19 lockdown. So in this Chinese language internet news, what it says is that one of the big 4 Chinese developers called Henta, they managed to sell 47,540 units of property that is worth 58 billion RMB within COVID-19 lockdown period. And how they do it is pretty much using online. So they pretty much digitize the whole real estate sales and marketing process from beginning to end, such that people can view property, people can evaluate property, people can see property, people can choose property, and people can make payment without the need for one-to-one personal contact. Next. And of course, by March, COVID-19 has pretty much recovered in China, and China housing market spring back to life as early as March. So I would say, as far as the whole is concerned, China is the first market to recover from COVID-19. And we see sales tripling in 30 major cities across China. One of the key reasons is the pent-up demand, where people cannot buy property in the first 2 months of the year. And when March reopened, a lot of people rush to buy property. Next. So we also work with our Chinese partner, Untitled, which is the biggest property portal in China, to do some research and data analysis on what happened after COVID-19. So we can see that after COVID-19, there's an interesting increase in inquiries and interest in overseas property. For example, there's a 93% increase in page view for Southeast Asia property, 92% increase in page view for overseas properties, and also 71% increase in inquiries for overseas property. So henceforth, what we say is that COVID-19 actually spurred the Chinese to be more interested in overseas property investment. I think one of the key drivers for that is because they are looking at buying a home for their own stay in the next winter, and also buying a home where they can find a place where there's adequate medical infrastructure to support themselves, especially when they are old age. Because the COVID-19 outbreak in China has actually dawned upon many Chinese that the current healthcare infrastructure in China is probably not enough to cope with 1.4 billion people. So that got them started to think about buying a home for their future. Next. So what could be the new normal in China pertaining to real estate? Can you play the one on the left? So the new normal that we envisage is using the example that I quoted for Henta in the earlier slide. People are no longer averse to evaluating, to marketing, to promoting, to giving a webinar like this in terms of property presentation. So this is becoming the new normal in China. In fact, this live streaming session called 直播 in China has become so predominant that even up to now, when COVID-19 fully recover, many real estate companies, many real estate agents are still using this method to reach out to the Chinese market. This also goes in line with what Dr. Gan Lu mentioned earlier, where live streaming become almost a de facto marketing channel for the marketers, for the companies to reach out to the buyers. I'm also happy to share that PropertyGuru has also initiated this new channel to allow our Southeast Asia developer to reach out to the Chinese market without the need to travel to China in the light of the current travel restriction. Next. Okay, so with that, I round up my session, and therefore I would like to start off with a panel discussion. So for panel discussion, what we will do is I'll start off with a couple of questions for myself to interact with the fellow panelists. And after that, I will check out on the Q&A box to see what are the questions that the audience have in mind for the panelists. Feel free to ask. I will start the warm-up by asking the panelists some questions that I have in mind. So one of the burning questions I have in mind is what is the impact of COVID-19 on the real estate market? And this is actually a question that I will break down into 1A and 1B. 1A being the impact on consumer behavior, meaning to say how has COVID-19 changed the way consumer live, work, and play, and their corresponding impact on the real estate market. For example, if let's say do people permanently don't do retail shopping anymore? Do they switch to online? For example, do people really work from home more, and there's a less need for commercial office space, for example? And what about the impact on residential? Do people need a bigger home because they need to work from home more? So I would like to examine the impact on consumer behavior, which again correspondingly affect the real estate landscape. So I would like to go down the line for each speaker to comment on the impact on consumer market, which is 1A of my question. After that, I'll move on to 1B. So maybe let's have James, since you are the first speaker. I will go down the line for James to comment on that.
Sure. I mean, I would say that obviously most people know that sort of China already has a relatively robust e-commerce market, and we're actually sort of seeing a growth in terms of that already. So I think COVID-19, while it has had an impact and it has created new businesses, is pretty much accelerating a trend which was already in place. Also, I would say that China, compared to a lot of other countries, has a relatively short period in terms of lockdown. When you compare it to what's happening in the US and Europe with the sort of a 6-month lockdown, for many people, was only 1 or 2 months. And so the ability to be able to switch back to where you were before was relatively easy. So I would say it's basically acceleration, and then we sort of reverted back to normal relatively quickly to a certain extent.
Dr. Gan, I think you are in a good position to comment on the impact on the COVID-19 on any changes and any permanent changes on the Chinese consumer behavior.
Well, maybe to me, I think we should look at two sides, right? I think definitely there's a lot of change, but also it is something we realize it cannot be changed. I think I might be, maybe just happened to me, or I might be wrong, but just to just give like an example. I think to me, I think even like a younger generation or at the age like me, like around 40, I think, after the, during pandemic, we really want to go back to offline life. I mean, go to a restaurant and go to a hotel, because it's a totally different experience, and to me. So I think once everything kind of 100% recovered, we will do the same. And if we talk about e-commerce, talk about like online service, I think we already kind of get used to that even before the pandemic. But maybe we use that more like online conferencing. Maybe we did more, but it's not that new to us. But so this is one side, but on the other side, and just give a very interesting example is my parents at the age of 70s. I think they never try that e-commerce that much. But what happened during pandemic? Because first of all, they don't like to go shopping anyway. But before they have to, because they don't know how to play with a smartphone or Pinduoduo, all this stuff. But during pandemic, they have to learn how that works. And now they kind of get used to it. Like in my home, we have delivery every day. Like my parents, over 70, they buy stuff, and because they're cheap on Pinduoduo, and they feel it's really happy because they're always concerned about price. But if the price is okay, they buy it. Then like last week, I tried to convince my parents, okay, let's go out, to the shopping mall and have a walk. And I'm being told by them, say, oh, they don't want to work that much. I think the kind of pandemic, keep them, they become lazy, and compared with the before pandemic. I think this is kind of change. So I would say, we need to look at two sides. And for us, we miss offline. I don't think online can replace part of offline behavior. So that I think that will be drive more business or drive better business, to push the offline business to think about, to kind of adopt the online digital solution. But on the other hand, some people will get used to online service.
Okay, how about Vincent? What's
Yeah.
your view?
Yeah, in Hong Kong, you can see there's a correction on the retail property and also the office property price. We can say that COVID-19 was the last straw for this both markets, especially for the retail markets. You will know that, say, in Hong Kong, the retail property rental is very expensive. For a restaurant, the unit rent for a restaurant may be ranging from like 50 Hong-Key per square foot to almost 150 Hong-Key per square foot. So after the COVID-19, the people will think that if I am the restaurant, I'm running the restaurant, why we don't just move our business to a central kitchen, which is like the food court, but we don't receive the people. We just deliver the food through a central kitchen instead of a physical restaurant, on the street. So that's one thing. And another thing is about the office. Before that, say why the office rent or the price push up to the sky high, it is because of the emergency of the co-working. The people will think that, say, after the COVID-19, more people will prefer the co-working and more people will try to start up the business because a lot of, say, set off from the multinational companies. But the reality is, say, no matter for the multinational companies or for the startup companies, we think that, say, actually for the backup staff or for the admin staff, we can just leave that at home. Just like the teachers in the US, they ask the people to stay at home after the COVID-19. You don't need to go back to the office after the pandemic. But why there's not much impact on the residential market? First of all, is about, say, the co-living doesn't work under the pandemic because the people would concern about the hygienic issues. And also the residential property is the basic necessity for all the people. They can't find any alternatives for the residential properties. And it tells why the COVID-19 gave a big hit on the office market and the retail market, but it doesn't have much impact on the home markets in Hong Kong. Yeah.
Okay, how about Ivan? What's your comment?
I'll be interested to see like what the impact between Singapore and China opening up the travel bubble. I think that will actually would see a little bit of a light on the road to recovery in the property industry as well. Shops, restaurants all reopens, as well as the increased demand in accommodations for essential travelers, as well as the domestic traveler resumes. I remember before your circuit breaker in Singapore, your Prime Minister, Lee Hsien Loong, actually encourages people to actually go to stay in a hotel in Singapore for staycations instead of going elsewhere. So I guess it would be interesting to see how things works after the countries are slowly opening up. With the world now, China is the first one, pretty much the first one switching to the recovery mode. During this period, I think everything, including Australia, is being reassessed, recalibrating what is going to be the new normal. The new normal is going to make a very huge impact on the supply and demand of the real estate market globally in different segments. I think will be interesting to see how quickly China will react and adapt very quickly into the new norm. Well, which means it's actually already showing some signs that we actually don't need that much space for a physical meeting, because now everything can be taken online, and people are getting used to doing online meeting. and we are expecting less travel between countries or even between cities. So accommodations demand will be less. And for a residential point of view, we do actually have talks about people are utilizing staying at home, working from home a lot more. And there might be a need to rethink or redesign future homes. So to cater for work capability in your own residence, and even conducting business, having duplexes, so you can actually do business while you are living in the same place. So there's a lot of things that will change, and we are already seeing that changing, certainly in Australia.
I will also take a quick deep at some of the questions being asked by the audience. There are quite a number. I will start off by answering one question about what, besides Singapore and Malaysia, what are the other Southeast Asia countries Chinese residential buyers are looking at? So our response to that is based on our data point. Other than Singapore and Malaysia, the other countries that Chinese buyers are interested to look at will be Thailand, Cambodia, and Philippines. So all these are key market of interest for Chinese buyer for Southeast Asia. And there's also another question about would you think the current strong rebound may reverse if there's a second and third wave of COVID-19 outbreak? Do you think the property market is resilient enough to withstand any further market downturn in the region? Should that be a situation whereby COVID-19 is not under control? Any takers for that question?
Perhaps I can talk about something about any other opportunities outside, say, China or Hong Kong, or mainland China or Hong Kong. So to me, say, I would be more focusing about the currency volatility of the country if I'm going to invest over there. So if the currency volatility is too high, that means the risk is not just from the property market, it's from the currency market. So if you see that, say, a lot of the people saying, shall we invest in Malaysia? But if you look back to the currency volatility in Malaysia in the last few years, even though you may get some profit from the property price increase, however, if you are using the US dollars or the Hong Kong dollars to buy the properties over there, definitely you will have a loss on the currency. So to me, say, even though a lot of people saying that, say, just like Vietnam or Cambodia, there are quite a lot of opportunities over there, because a lot of the Chinese manufacturers have to move their plants over there. But I did interview some of the manufacturers in China. I asked, would you buy the home properties over there? And most of them say no. Actually, they just move their plants over there. They may have the dormitory for their staff. They may rent the dormitory for the staff, but they would not plan to move over there, and they will not invest in the property home market, because they a lot really want to invest over there, but they have to because of the tension between the US and China. And that's why I say why they don't prefer to invest over there, it is because of the currency issue. So I don't have some specific, say, location that I would suggest to invest, but I would advise the people to take more attention about, say, the currency volatility of the other countries in the Asia.
I think, Winston, I can add on. I think not blowing our own trumpet, but Australia is a good destination for people to look at, and a lot of people are actually looking to Australia because like how well we have managed the pandemic, and you know, at the moment Australian dollars is on
strong.
It's very low compared to where it was before. It has bounced back. It has bounced back very quickly. We've seen Australian dollars hitting the 70 cents US dollars mark, and the share markets has gone up. But our interest rate is on record low, the lowest we've seen so far in history. So there is a lot of opportunities for people to look into the Australian property market.
I'm asked by the organizer that we have reached our time. So let's try to thank our speakers today for spending the precious time to share with us. I wish we can do this longer. And also thank you, audience, for participating in our live webinar today, China Reopen. Just remember to visit the Asia Real Estate Summit.com website in the next few days, where we will share the full recording of our session today. And without much further ado, I shall declare the end of our webinar today, and looking forward to meet up with you guys after the whole travel lockdown. Thank you.
Okay, thank you.
Thank
Thanks
you.
very much.
Goodbye.
Okay, bye-bye.